Meanwhile, in other news, traders at UBA say that they expect a pickup in activity in the near term, supported by the expected strong demand at the next Treasury Bills auction. Meanwhile, at Wednesday's auction, the DMO allotted 952 billion naira despite subscription reaching 4.59 trillion naira. Fahad Aliu, the team member for bond trading at UBA, joins me now for this discussion. Thank you so much for your time today, Fahad. Quite an interesting week, but bring us up to speed on some of the key points and key moments here for this week.
Thank you very much, Kenneth. So activities this week has mostly been on the Treasury Bills market, where the DMO offered a total of 1.1 trillion. Subscription was very high as expected due to this high system liquidity. We saw subscription at about 4.5 trillion, and the allotment was now 152 billion. Because of this high subscription and high demand from the market, we saw rates decline to a whopping 16.987% on the 364-day paper. And currently in the secondary market, this bill is trading at 15 levels, which shows the strong demand, a persistent strong demand over the past few months.
All right, on the allotment, they're just under a trillion there, but would you say that's more like a comfort with liquidity levels that they are, or more or less an attempt to manage yields?
I think it's an attempt to manage yields from the DMO. We've seen that over the last auction at the also they didn't sell up to the amounts that they offered. So it has been a consistent thing from the DMO to manage the yield and try to borrow for the government as cheap as possible.
Still looking at the market, we're seeing that the 364-day stop rates also fell sharply, dropping to about 16.9% there. You know, in terms of what's happening, would you say it's a start of sustained yield compression or just an auction-specific move?
So going into the year, when we started 2026, the expectation was rates was going to go very high due to the high borrowing from the government. But as we go into the year now, expectation of MPC, high system liquidity, these have been drivers that have been driving the market until where we are today. We are currently at 16.98, but we expect the decline to continue as far as this liquidity persists in the market, and as long as we have that expectation from the MPC. Next in 2 weeks.
All right, let's get into that expectation, because even my previous guests talked about that. Also, they're also having feelers in the market to see how things will play out there. But what's your call on what the central bank will make, decision they will make this time?
Okay, so we've seen inflation drop consistently over the past few months, and currently at 15 levels. We can see that the differential between inflation and interest rates is currently very high. So we expect MPC to drop the rate a little bit, but modestly, not as aggressive as some people are expecting. So we see the rates dropping by 25 or 50 basis points, at the next MPC auction.
Okay, interesting call there. But then let's get into the bond space, and I see that you also flagged more or less some bullish bias there. Speak to what's happening there and how you're calling this down the line.
Yeah, it's been very bullish in the bond space since the auction. The stop rate at the auction for the 2025 bond was at 17.52, and for the 2034 bond was at 17.5. And ever since then, currently these securities are trading at 16 levels. So we've seen a decline in yield, we've seen demand, and a lot of people are leaving the Treasury bill space because of the withholding tax component, right? We have seen those demands seep into the bonds market now, and the bonds market has been very bullish ever since then, and we expect this bullish bias to continue going towards the end of the month.
What about secondary market activity, and how are you calling that one?
Yeah, in the secondary market, like I stated earlier, rates are currently at 16 levels, especially on the belly of the curve. We've seen serious demands, across board, with limited supplies to cover these demands, and as a result, we expect this bullish bias, like I said, to persist till the end of the month.
All right, then on the other interesting bit, then we're looking at the FX market there and the outlook there. We're seeing the demand-supply dynamics coming to play out here, but then interesting move from the central bank there. How are you reading that move from the central bank?
It's been an interesting week so far in the FX market, to be honest, because this week, since last week actually, we've seen demand. We've seen demand coming to the market. So we've seen supply rather. We've seen a lot of inflows coming to the market with limited demand, and as a result, it has dropped rates significantly. We are currently at 13.59. That was where the rates closed at the FM market yesterday, and this was as a result of significant demand from significant supply rather from inflows from FPIs coming in, to invest in high yield OMO in the market, and because of this, we saw CBN for the first time buy dollar from the markets. Usually we're used to them selling dollar to the markets, to augment the interest rate. But this time around, we saw the CBN come into the market to, mop up the dollar at 1365 levels.
Interesting times, you would say. But finally, what trends do you think will continue to shape the rest of the first quarter?
So the CBN has shown that they are trying to sustain the rate around that 13.5 levels. They don't want it to go below that rate. So we expect that market dynamics to continue to hover around that 1350 levels in the FX market.
All right, thank you so much for that, Fahad Aliu there, the team member, bond trading at UBA.